So this is a follow-up video to a video that I made yesterday night on trade execution. A lot of people by now have watched that video, and a lot of people have thanked me for making that video because they wanted clarity on how exactly to execute the trade. What is the right price to buy and what is the right time to buy? As professional stock traders, our goal is to buy the right stock at the right price at the right time, which is what was discussed in yesterday's video on trade execution. On that video, one of my YouTube subscribers, he asked me a question. He said, Rohit, you have explained how to buy the stock inside that yellow band on this chart, which I used in the video that I made yesterday, but you have not discussed about stop loss placement. So that is why this is a follow-up video. Now I am going to talk about stop loss placement. Because remember, in the orange trading system, after you place the trade, the next part is risk management. So let me open that for you so that it becomes easy for you to understand that orange trading system framework is something that I show to all of my subscribers almost in every video. So let me go there. So the orange trading system allows me to give you context. So let me open this. Have a look at this. Yesterday, I spoke about trade execution. After trade execution comes risk management. Risk management is what? Stop loss and position size management, correct? So after trade execution comes stop loss placement. So today's video is about this risk management. Going back to the chart. Let's go back to our chart. I will expand this. So during trade execution, you will end up buying all of your 100 shares or whatever the number of shares that you plan to buy within this yellow band. Okay, so what is the yellow band here? 1109, 1120, correct? So let's assume that we buy the stock in three different tranches, 30 shares, and 40 shares on the intraday time frame chart, and an average price that we get lies within the yellow band. So let's say our average price is 1112. Okay, 1112 is our average price. So what I will do is first I will draw the line. Okay, 1112, that is our average execution price. Your broker is the only one who can provide you this average execution price because you put your orders with your broker sends the order to the exchange, the order gets executed. Now you get the average price at which you were able to buy each stock, each share of this stock. Let's say that price is 1112. Let us give it green color, okay? Because it's this color coding is also very important. I will give it green color because that is the price at which I bought the stock. Okay, so the green color will always fall inside the yellow band. Okay, so if I do this, see the green is inside that yellow band. Now, after I do this, the first thing I do is I put the stop loss at 8%, which is our standard stop loss, which is also discussed in William O'Neill's book. So let's do that. Let's put an 8% stop loss below our average execution price. Remember, the stop loss will be 8% below the green line, this green line. The stop loss will not be 8% below the yellow line or below the yellow band. Okay. We want the average execution price. That is very important. First, we get in and then we put a stop loss. Okay. So let's calculate our stop loss. What is our stop loss level? It is going to be 8% below the green line. That means 92% of the green line is our stop loss. So let me open the calculator. Earlier, I used to show you, this calculator, but I want to show it to you here now. So not camera, sorry. I want to show you calculator. Yes. So this is the calculator. I will put 1112 multiplied by 0.92, 92 is equal to, so 1023.04. So let's take 1023. Okay. So 1023 is our stop loss. So let me give it red color. 1023. I give it red color because it's the stop loss. Okay. See, after I put the level, the stop loss comes here. So the stop loss is here. Now this is called as the hard stop loss. Hard stop loss means this is a GTT sell order, which is an automatic sell order that I place with my broker. Okay. So if the stock hits that price, I'm automatically going to be kicked out of that stock. So that is called as the hard stop loss. Apart from hard stop loss, I also keep something called as a mental stop loss. A mental stop loss is a level that I am personally watching on the stock. If the stock breaks that level or if the stock closes below that level, I might consider reducing my position size. So in this case, if I draw the points in the base, so this is point 1, this is point 2, that's point 3, point 4, point 5, point 6, 0.7. So can I take 0.6 or zero point 0.4 or zero point 0.2 as my stop loss? Obviously, we can do that. So I will take 0.6 as my mental stop loss. So 0.6 is the low of this candle, which is 1050. So let's draw a line there. 1050. 1050. Let us give it blue color. Okay. This color combination is important. You can use any color you want. I am just using blue, green, red. Okay. So this blue line is my mental stop loss, which means, let's say, see, I get execution at this price, right? The green line, that is my average execution price. After touching the green line, okay, or after creating that green line, if the stock begins to fall, if it touches the blue line or if it closes below the blue line, I might consider reducing my position size, right? Because I want to control my risk. Now, you notice the mental stop loss is less than 8% because this red line is 8%, correct? So, the mental stop loss is a level that I'm watching on the chart, which if it is broken, it will prove me wrong. Okay. See, there has to be some level on the chart which will prove me wrong, correct? How will I know that I am right or wrong on the stock? Ideally, in a breakout kind of a situation, or ideally in a VCP kind of a situation, that point number 6 should not get broken. After this, the stock should start moving up, correct? Or it might create point number 8 here. Okay, and then it should start moving up from there. Ideally, that should happen. That is what happens with a VCP pattern most of the times. So if that point number 6 gets broken, that means the pattern is becoming invalid. And by the way, if point number 6 gets broken, chances are very high that it will also break its 50-day simple moving average. Look at how close that 50-day simple moving average is to the point number 6. So that's a critical level that I am watching. Okay, so that's a mental stop loss. So it's not placed with the broker, it's a level that I'm watching. And the reason why I have to draw that blue line is because after I buy the stock, I sometimes might forget where my mental stop loss is. And mental stop loss is something that we have to keep moving. Okay. Hard stop loss is something that we don't play with, we don't tinker around with the hard stop loss. It is placed at 8% peacefully. Okay. It is only for emergency purposes. Okay. Usually stocks which are forming a tight base on the right side do not fall back 8% if they are bought properly on high volume at the right price. Okay. Usually that should not happen. If it happens, then we have to book the loss. Okay. Now we have spoken about mental stop loss and hard stop loss. Let's take this discussion further. Now I'm getting into trade management. As the stock starts to go up, where would I keep my mental stop loss, or where would I keep my uh, hard stop loss. Now, trade management is a very long discussion. Here, I will cover just one small part of trade management because this video is specific to stop loss. One thought that came to my mind yesterday night is the person who is asking me a question on my YouTube video, that I should give credit to that person. I should take the name of the person who has asked me this question, which allows me to create a video. It's like that person giving me a idea to create a video. So I thought, why not give credit by taking the name of that person? Then I realized that taking the name of the person who has asked me this question is not good from the point of view of privacy. Then I thought, why not take the first name of the person, because I have to give credit to that person. Why not take the first name of the person and eliminate, not take the second name of that person? Then I sat back, relaxed, and asked myself, what is the purpose of this YouTube channel? Is it to please someone by taking their name, or is it to educate people who come on this YouTube channel? When I asked that question, I got clarity in my mind. The purpose of this channel is to educate. The purpose of this channel is to inspire you to become a professional stock trader. The purpose of this channel is not to please someone by taking their name. In fact, the purpose of this channel should be to protect the privacy of people who are subscribed to this channel. If somebody is asking me a question, I should not be taking their name. Now, if you are someone who has asked me this question on which I am making the video, please be rest assured that I respect you, but I cannot mention your name for privacy reasons. Okay. Of course, people can go back to my previous videos and check who has asked this question, but most people will not take that effort. But I don't want to publicly mention someone's name. But I do give credit to the person who has asked this question, and I respect that person. So please send me your questions. I will make sure I will answer your question on this YouTube channel. If not today, I will make the video this week sometime or next week sometime. But I will definitely make that video. And if I reply to you saying that I will make the video, rest assured that the video will come. Okay. If not today, maybe after 2-3 days, the video will be there on the channel. So questions will be answered. Please keep sending me your questions. Your privacy will be protected. I just want to keep this channel pure, clean, and ethical. I don't want to tell my story on this channel. I just want to educate or share through this channel. No stories here. We are directly discussing charts. Okay. That's a little diversion that I took when that's a bad habit that I have. When I'm talking about some important concept, my mind suddenly digresses into something else. Coming back to the concept. So the stock has broken out. We bought it at green line. Blue line is our mental stop loss. Red line is our hard stop loss. One thing which we have not yet discussed is position size. So let's say we take a 10% position size with a 8% stop loss. So what is our risk? So position size multiplied by position risk is equal to what? Portfolio risk, right? Is my spelling correct? Yeah. So what's our position size? Position size, let's say, is 10% multiplied by what is position risk? Position risk is nothing but stop loss. So 8% is equal to 0.8%. See, now you will understand the importance of a mental stop loss. See, my original stop loss is 8%. So my total portfolio risk is 0.8%. So if the stock hits my 8% stop loss, I will lose less than 1% of my overall portfolio. Is that good risk management? Of course, that is good risk management. I am risking less than 1% of my overall portfolio on a stock which is already in a confirmed stage 2 uptrend, which is already forming a base, which is already giving me 6 points in the base, which is already giving me tightness in the base, and which is breaking out on high volume. Okay. On that kind of a high probability setup, I'm only risking less than 1% of my portfolio. That is proper risk management. On top of that, I am putting a mental stop loss where this number is probably 6%. I don't know. Let's check. So if I measure from green line to blue, that's 6%, 5.5%. So mental stop loss is 5.5%. So I'm actually risking 0.5% of my overall portfolio on this trade while taking a 10% position size. So I'm putting 10% of my portfolio in the stock while risking less than half a percentage point of my overall portfolio on that stock, right? That is called proper risk management. Now, this position size thing, okay, this depends on what is your level of experience. If you are an inexperienced trader, if you are just in the learning phase, keep this small, maybe 5%, or the ideal that I mentioned in one of my previous videos was 6.25%, because 6.25% is one quarter of 25%. Okay. 6.25% or 5% position size can be used for people who are inexperienced with this system. But if you have even 1 or 2 years of experience with this VCP pattern, I think 10%, 6.25 to 10% would be a decent position size. People like Mark Minervini and his students might use 15%, 20, 25% position size to capture maximum gain in a very short period of time. But that comes with risk. The higher the position size, the higher is the risk. The higher is the position size, the more is the need to micromanage the trade. Okay. But 0.8% is very much acceptable. Let's take it one step further. Okay. Now the stock has broken out. This single candle is a 9.24% candle. Look at this number, okay? This percentage number. This candle is 9.24%, okay? Now tell me one thing, if a stock goes up 9 to 10% in a single day, don't you think you should be taking some steps to protect your unrealized gain, or at least protect your capital? Would you like a stock which has gone up 10% to come back and hit your 8% stop loss? For that, the stock first has to travel like 9%, then another 4, 5 or 6% to hit your 8% stop loss, right? So the stock will have to travel like 15 to 16% to come back and hit your stop loss. Would you like that to happen on a position? The answer is obviously not. You wouldn't sit there watching a stock drop 15% in front of you and take away 8% of your money. You are not going to do that. You are a professional trader. So the solution to this is, can I move my blue line, the mental stop loss, to the low of this candle? Can I say that if the stock starts to pull back, it could pull back, find support at the yellow band, and then start moving up, which is called as the tennis ball action by Mark Minervini in his book, right? I think he spoke about tennis ball action in his second book, Think and Trade Like a Champion. So if the tennis ball like action comes in this stock, can we say that the low of this candle will be respected by the market? The answer is yes. There is a good probability. Another thing is, I wouldn't want a stock which has already gone up 10% to come back and hit my 8% stop loss. That is going to be emotionally very painful. So, what I will do is, I will move the mental stop loss or hard stop loss, depending on how much risk you want to take. I will move that to the low of this candle. What's the low of this candle? 1090. So, I will take this, I will make it 1090. See, at the low of this candle. So I am saying that if the stock comes down, touches this yellow line or closes below the yellow line, that means my pattern is void. The stock is not doing what I expect it to do. I expect the stock to continue going up, or I expect the stock to come down, find support at this yellow band, and then start moving up. Those are my two expectations. But if none of those two expectations are met and the stock touches this blue line or even closes below the blue line, I might start reducing my position size, because that is not what I expected to happen on this stock. Okay. Let's take this one step forward. Remember, the hard stop loss is still at 8%. I don't want to play around with the hard stop loss. Okay. Let's take this one step forward. Now we are talking about trade management. Have a look at this candle. Okay. If I measure the distance from the green line to the high of this candle, okay, that's almost 40%, 39.07%. Okay. Basic knowledge, if you read William O'Neill's book, basic knowledge tells us that any stock that breaks out of a proper VCP pattern, which is a confirmed stage 2 uptrending stock, any stock that breaks out of a proper tight VCP pattern should go up at least 20 to 25% before it starts forming the next base. Okay, it has to go up 20 to 25%, or there is a good probability that it will go up 20 to 25% before it begins to form a new base. Why would it begin to form a new base? Because the market needs some time to digest that 25% gain. 25% gain on a stock is a huge gain on the stock. Imagine 10% position size, 25% gain on the stock, that's 2.5% of your portfolio, right? And 25% gain, stop loss of 8%, that is a reward to risk ratio of more than 3. That's a fantastic thing, right? Now, on this day, now this here I'm talking trade management. On this day, by the time the stock reaches this high level, okay, if you are watching the stock on this day, by the time it reaches the high here, you are looking at a very large green candle. Okay. Now, if you look back on this stock, that kind of spread means the distance between the high and the low. If you look back in the past 1 year at least, you have never had a candle which had that kind of a spread. Look at the height of this candle. Okay. So when it touches here, okay, you are looking at the largest spread on the candle. uh, if we look back past 52 weeks, in the past 52 weeks, there is not a single candle where the spread is as high as this candle. Okay. So what do you do? That's a good opportunity to take some money off the table, right? And armed with the knowledge that a stock usually should start forming a base after it hits the 25% level, what you do is, if you see the stock reaching here midway during the day, let's say 11:30, 12 o'clock, the stock hits this level and you are sitting on a 38% gain, okay, from your green line. What you could do is, you could take this price, the average execution price, and calculate, go up 25% from that level. Okay. So 1112 multiplied by 1.25. Okay, so 1390. So why not put a line at 1390? 1390, give it green color, which is our target achieved. Okay. So why not, when the price touches here, okay, you know that on that particular day, your ideal, your mental target, see, this is a mental target. That is not a automatic, this green line is not a sell order. That's a mental target. Remember, in one of my previous videos, I told you to draw two lines. After you buy a stock, you draw two lines, one at 20 at one at 25%. So if I draw those two lines here, let me draw a line at 20%. Okay. So 1112 multiplied by 1.20 is 1334. Okay. So 1334. So if you notice here somewhere, the stock has started to go into your selling. This is the selling zone. This is 20% above your buy price. This is 25% above your buy price. Now, on this day, you know that the stock has breached your selling zone, which means there is a very good chance that the stock might start forming a base. Okay. I am telling you, at the moment when the price hits this price, somewhere here, or when the stock crosses this green band, okay, you have to become alert, because the stock is getting extended now after that 25% level. What could you do here? You could do two things. You could either move your blue line, which is the mental stop loss, to this level, which means you are saying to yourself, if the stock breaks that level, that this particular level, let me remove this. You will move your blue line to this green level, okay, and you will say that if the stock breaks that level, closes below that level on a 5 minute or a 15-minute chart, I am out of the stock, so that I am protecting my 20 to 25% unrealized gain, right? Or I would simply move the hard stop loss to the green line. So if it comes down, I will be automatically kicked out of the stock, thereby guaranteeing the 25% return, because I have moved my stop loss to that level where 25%, the green line is 25% above my buy price. So I am ensuring that I am getting that 25% return from that stock by moving my automatic sell order to here. Remember, this need not be always below the buy price. It could also be above the uh, buy price, or you could move it to 10 or 15% level somewhere here. Okay, somewhere at the low of this, maybe at the low of this red candle. Can you do that? Of course, you can do that. This is a red line, by the way. This is the stop loss you set with your broker. So this is a way to manage or move your stop loss. Why do you move your stop loss? To control risk. Why do you reduce position size? To control risk. Why do you reduce your position size and move your stop loss up? To significantly bring down your risk. See, by the time you move your hard stop loss from here to almost here or here, you have eliminated the risk in this stock. There's virtually no risk in the stock unless the stock gaps down below this red line. Next day, if the stock opens below the red line, that is called risk. But when you move this red stop loss above this green line, then this formula no more applies, right? Because you are not, this position risk is eliminated here. So there is no risk in that position. So this is called as de-risking the trade. Okay. So the sooner you de-risk the trade, the better it is. Another idea I will give you. Let's say you move your stop loss from 8% to this. Okay. Now you have already set the price in the order, correct? This is an automatic sell order. But remember, in an order, there are two things you have to place in the order. One is the price at which you want to sell, second is quantity, right? Who told you that whatever quantity you bought here is the same quantity you have to put here? Why not put 50% of the quantity? Why not put 75% of the quantity? Why not put 25% of the quantity? Why not do partial selling? Can you do that? Of course, you can do that, right? So let's say you move your stop loss here. You bought 100 shares here. You put, let's say, 45 shares uh, in this order. Remaining 55 shares, you keep the stop loss at the break even point. Okay. So on 45 shares, you end up booking gains of 25%. On the remaining 55 shares, you cannot lose money because your stop loss is at break even. So trade management, you can play around. You can be very creative with trade management. But when it comes to trade execution, stop loss movement, you have to give it a thought. Okay. And stop loss also, by the way, depends on a lot of other things. Suddenly, during this uptrend, if there is a quarterly earnings report, if the market conditions turn to uptrend under pressure or downtrend, then you have to be aggressively moving the stop loss up, or you have to be aggressively selling, reducing your position size. That's a different subject altogether, which I discuss in detail in my video course. But I just wanted to give you an example of how I would think about a particular position. It's all there on the chart, by the way. There is not, you don't have to look beyond the chart. You don't need any indicators here. Okay. So I hope uh, this was helpful to you. Thank you for the thank you to the person who asked me this question about the stop loss. I hope this is clear to you. I will see you in the next video. Thank you so much.